In today's video, I'm going to have a quick chat about whether dollar cost averaging, or lump sum investing is the best way to go. The question of which is better is one that I keep getting asked, and most recently Shane asked me in a comment to one of my videos. So thanks very much, Shane, for the question. So imagine we have £1,000 to invest. Would we be better off just dumping that straight in, or should we trickle that in over time? There is lots of debate about which is the best way forward, but some of it comes down to you and what is your risk appetite. We'll go through quick definitions, look at a few different studies, and see what the experts and the academics are saying is the best way to go. Welcome back to the channel, and if you're new here, hi, I'm Mark of Desperately Seeking Fi. So what is cost averaging? Cost averaging is basically just doing regular payments over a long period of time into the stock market, and you're not worried about any of the price variations that go on. It's just a steady amount of money going in on a periodic basis. Let's do a quick example. Say we have £1,000 and over the next 5 months we want to invest £500 per month into the USA. So let's do an S&P 500 ETF. We split that down and we're buying in, and let's say it's on a real bargain at the moment, and the first month it costs you £50 for VUSA. Next month, 45, then 51, 47, and 52. That gives you a cost average of buying into VUSA of £49 for each of those shares. That means you are done. Let's have a think about what some of the benefits are. We have psychologically, you are just putting in and you're not worried about losing everything, because that's what lots of people think about. They think they're going to put money into the stock market. It's really risky. I might lose everything. So by dripping in smaller amounts, you are being able to sleep at night. And another benefit is if that stock price is dropping, you are buying in at a discount as it goes down. And over time, you could end up with a far better cost average, which means when things turn around and start going back up, you're then much more in profit. There are some risks. What happens if the cost of everything goes up? You're going to be paying that little bit more for each of your incremental purchases as you move into the market. You'll miss out on gains because obviously that cost average is going up. And what happens? You might buy a Palantir that just keeps dropping and dropping and dropping. I know it's picked up a little bit recently, but there are many stocks out there, particularly some of those growth stocks, that with the next big thing, they just crashed to nothing. And you're just buying in on the whole way down. You don't know if it's going to pick back up again. Lump sum investment is, as it says on the tin, a lump sum investment. You are putting all that £1,000 in at one time, and if you think back to the start of that example, you would be buying into VUSA at £50 per share. Therefore, if it goes up, and at the end of that example we were sat at £52, you would have moved up in a cost average per share by £2. Quids in. There are some issues with this whole investing into the lump sum. Nobody knows what the future is, so you don't know whether the market is going up or going down. What are the benefits of that lump sum approach? Obviously, if you've invested all your money and you've got the timing right and the market is going up, i.e. a bull market, you will see gains. However, if you put all your money in and things start going down, which they do every so often, if we have a look at this chart, you can see if you'd chosen the wrong time to invest, you'd have made a loss. But what this doesn't account for, and what lots of the different bits of research don't really take into full account, is the time frame that you're actually investing in. If you were to have invested just before COVID-19, when the stock markets were high, and then you pulled out a few days after that crash, you've obviously lost your money. But if you are looking at longer term investing, you can potentially ride out some of those dips. And if we think about it, the one thing that we can say about the stock market is it goes up and it goes down. That's just life. There is also the fact that it doesn't, all this research potentially doesn't take in all the risk factors, and there are variations in how they've actually measured things. But let's have a quick look at this chart that sort of gives you an idea from 1997 out to 2022, looking at DCA outperforming a lump sum investment into the S&P 500. If you look at this, you can see anything above that zero line is where DCA is working better, and then below is where a lump sum investment would work. And actually, if we look at what those correlate to, that first peak above the zero line is the dot-com bubble, and then you have the 2008 financial crisis. And that's when you buying in through time and DCAing would have given you a benefit. If we also have a look at this bit of work that was done by Vanguard on historical probability, and we must remember that past performance doesn't always give us what the future returns are going to be. You're looking at 68% of the time lump sum investing is better than cost averaging versus cash at 69%, and then lump sum versus cash 70%. I think what we can see from that is forget about holding cash, because in the long run, but go and do your own due diligence and figure out, is that something that you want to do? Quite a lot of these studies don't always do is take into account risk. And when I'm talking about risk, I'm talking about standard deviation, so the movement from the mean. And what you find is that lump sum investing is much more volatile. There's a greater movement from the mean, and by quite a bit. I think it's standard deviation of 2% roughly for dollar cost averaging, so it is slightly more stable. And if you think about it, if you are buying in over a period of time at different price points, you are managing to balance that deviation. But on the lump sum, it is a lot more volatile. You could potentially get it wrong. So which is better? I suppose if we all had crystal balls and we knew what was going to happen with the stock market, you would know which was the better approach to go for. It all comes down to risk, your risk tolerance. What's going to keep you up at night, I suppose, is the key bit. If you are happier not pushing for the higher returns and just knowing that you are steady Eddie, go for DCA. Why not? Cost averaging might work for you. But there are other ways that you might wish to go around the lump sum investment. You might want to look at some form of portfolio rebalancing, and actually most people will say that that is a good way of doing it. And if you have a look on both my Trading 212 and Invest Engine accounts, I have set up what I want my ETFs to be set up at and what are the weightings of those. And if one starts performing too well, I want to possibly give it a little bit of a haircut and potentially invest that and rebalance it into some of the other ETFs that aren't performing quite so well. And that allows me to manage my risk that little bit more. Some of those platforms will also allow you to literally just do that automatically, and you can just click a button and boom, automatically just rebalances your profiles. Another thing that I haven't talked about is if you're doing this, maybe there are costs for all of this rebalancing. So once again, Trading 212, Invest Engine don't have actual trading costs. The only cost you'll pay is the ongoing charge or the total expense ratio for an ETF. Why not go have a look at one of those two platforms that you can invest into with zero platform fees? It takes out that additional cost that you might have and allows you to rebalance every couple of months, every 6 months, every year, whatever time period you are happier with. But with everything, investing is a personal choice. You have to do your own due diligence, your own research, so that you are happy with what is going on, and everything should tie into your goals, your risk tolerance, and the strategy that you are hoping to go to. Why don't you go and have a quick look at this video where I'm talking about some of the dividend ETFs that I am looking at. And I'm actually wondering what's missing off there. If you could drop a comment down below, I will look at redoing that video and bringing in some new ones. But thanks very much for watching, and I'll see you in the next one. Cheers, bye.